For this video, let's talk about the S&P 500 index and why it might be the greatest investment ever. The S&P 500 is common to hear about. All you have to do is watch the financial news and you may hear it said about 1,000 times a day. It's often referenced by well-known investors like Warren Buffett, and it's a common topic of conversation amongst financial content creators. I think it's safe to say that the S&P 500 has become the largest measure of comparison amongst all things stocks and financial markets. But for those of you still wondering, what's the big deal? What's so great about it? Let's break down what you get when you decide to invest in the S&P 500. The S&P 500 is an index, or basket, of the largest publicly traded U.S. corporations weighted by market capitalization. Anytime you hear market capitalization, just think that it's the company's number of shares multiplied by the share price. In other words, it's the market valuation of a company. Now, the businesses inside the index span across various industries. You'll find companies that represent sectors like financial services, technology, and healthcare. For this reason, the S&P 500 is generally considered to be well diversified. And this is the first characteristic that makes the S&P 500 such a great investment. Without a doubt, diversification should be a top priority for almost every single individual investor. And diversification is best explained with the old cliche of never put all your eggs in one basket, if the basket means an individual stock and the eggs are the dollars you're looking to invest. When you invest all of your money into one individual stock, you are subjected to 100% of the risks that company faces. So rather than investing all in one individual stock, which is considered risky, you take the money you're looking to invest and you spread it across different companies. And the premise of the strategy is if you were to ever enter a situation where that first company is harmed, the other companies that you've invested in will do okay. And you can get crazy with diversification. You don't just have to invest in different companies. You can invest in different industries, different asset classes, or even different countries. But to put it more simply, diversification saves you the stress of having to pick winners and losers. Especially when it comes to investments, winners can quickly become losers. So on the topic of diversification, let's actually break down the index, and you'll see household names like Amazon, Microsoft, and even Tesla. First, let's look at the top 10 holdings within the index. Like I said, you're going to see big household names. You have Apple, Microsoft, Amazon, Alphabet, Class A and C. Those are two different classes of stock that are the parent company of Google. Tesla, Berkshire Hathaway, Warren Buffett's company, United Health Group, Johnson & Johnson, and Nvidia. I think it's worth noting that 7 out of the top 10 holdings are technology companies, which is a perfect segue into the sector breakdown. So with 7 out of the top 10 holdings being technology, it's no surprise that technology is the biggest piece of the index pie. But as I stated earlier, the S&P 500 holds various different types of businesses. You'll have financials, healthcare, consumer services, industrials, consumer goods, oil and gas, utilities, basic materials, and telecommunications. And you can easily interpret these percentages as dollar amounts. So if you invested $100 into the S&P 500, 30 of that is going towards technology. Another 15 is going to financials, and the remainder is going across the other various sectors. Earlier I alluded to the S&P 500 as being the standard for comparative metrics. And it's become the standard because of the second and third characteristics that make the S&P 500 such a great investment. First, we have its historical performance. The S&P 500 has been around for a long time, so we have over 65 years of data. From 1957 to the end of 2021, the S&P 500 has returned roughly 11.88% compounded annually. I mean, just think about that for a second. For 65 years, this investment has returned 12% compounded annually. I mean, that's incredible. To really give you perspective onto that performance and how amazing 12% a year is, let's go back to the investor.gov compound interest calculator. Let's say the year is 1957 and I have $1,000 to invest, and that's all I have to invest. And let's say I leave that $1,000 invested in the S&P 500 for the next 65 years. And we know that over that 65 years, I could expect to earn 11.88% compounded annually. And look at that, ladies and gentlemen. At the end of 2021, if I was looking to pull out my money, that $1,000 would have grown to roughly $1,475,400. I mean, that continues to blow my mind. Think about the events that the United States went through between 1957 through the end of 2021. And still, the S&P returned 12% a year on your money. In fact, it's so amazing that I challenge you to find another investment that has returned 12% a year over 65 years plus. It's only going to be a handful. And that leads us to our next characteristic. The S&P 500 is outrageously hard to outperform. In a recent report, it was found that only 17% of professional fund managers were able to outperform the S&P 500 over a span of 10 years. But get this, if you were to extend that time frame from 10 years to 20 years, that number drops to only 6%. And to that, I say this. If only 6% of professional fund managers could outperform the S&P 500 over 20 years, imagine what those percentages would be if it was over 65. But like all things in investing, there are exceptions to the rule. And I think that's what makes legendary investor Warren Buffett so damn impressive. He's been doing this for a lot longer than 20 years and outperforming the market easily. So again, what adds to the greatness of the S&P 500? Well, not only does it have an amazing historical performance, but that performance continues to be difficult to beat, even for professionals. If all of that sounds great to you and you want in, I have good news and I have bad news. Let's rip the band-aid off. The bad news is you can't directly invest into the S&P 500, technically. But the good news is there are investment vehicles that are made to mimic the index in every single way. These vehicles are called index funds and ETFs, also known as exchange-traded funds. And all these vehicles allow you to do is to hold exactly what the S&P 500 does. And because that's all they do, they offer two distinct advantages. The first advantage that they offer to investors is that because they are so easy to manage, they're often referred to as passively managed funds. And all that means is that there is no fund manager actively picking and choosing stocks to accomplish whatever that fund's goal is. When a fund is passively managed, you can expect to see low expense ratios, and these are the percentage points that you will be paying for the right to be invested in that fund. And expense ratios aren't really entry fees per se, but they are used to pay for whatever overhead the fund may face. But put simply, the lower the expense ratio, the more profits you get to keep over the term of your investment. And the second advantage that these vehicles offer to investors is that they are highly liquid because there is such a large market for them. You will rarely find yourself in a situation where you're trying to withdraw money and you can't. So again, through these vehicles, you can own the S&P 500. In fact, the tables I've been showing you aren't even the S&P 500, but are actually the Vanguard S&P 500 exchange traded fund. So if you're interested, but you don't know where to start, here are some S&P 500 funds with low costs. And that's just a few of them, which brings me to the question of the day. Which fund do you use to invest in the S&P 500 and why? Before you all go, let's do a very quick recap. The S&P 500 is an index of the largest publicly traded U.S. corporations weighted by market capitalization. And the S&P 500 may very well be the greatest investment ever because of its 5 powerful characteristics. It's well diversified, it has a tremendous historical performance. That performance is hard to beat, even for professional investors. It's possible to invest at low costs, and it is a highly liquid investment. And that is all I have for today. As always, thank you for watching, take care of yourself, and best of luck.